reversals of all kinds, reversals, that means reversals in the market. There is a strategy called a reversal. Do you know what that strategy is, Bat?
A risk reversal you're talking about?
A risk reversal.
Sure.
Can you explain, or do you want me to? Do you remember?
Sure. No, I mean, usually, buy, call, sell, put, 100 deltas is a risk reversal.
Yeah, you
sell,
can
call, buy, put, buy, call, sell, put, whatever, 100 deltas, risk reversal.
Yeah, like a risk reversal would be something like, or a reversal would be something like you could create a synthetic stock, a synthetic short stock. So if you buy a put and sell the call at the same strike, that's a reversal. If you bought 100 shares of stock against that, that would be a flat position. If you buy an out of the money put and sell an out of the money call, that's still a reversal, but it's a risk reversal, but it has a smaller delta, so it's not quite 100 shares. And you can do that if you wanted to create a synthetic share equivalent. Those are, in the trading world, that's a strategy called a reversal. When we talk about markets, we talk about market reversals a little bit different. Today, we decided to cover reversals of all kind. You know why?
Because it's good to know.
Okay, I'll give you that, counselor. But really, because do you know what happened yesterday?
We had a reversal.
That is correct. So we wanted our research pieces.
Biblical proportions. But yes, go ahead.
We had a reversal in the market of biblical proportions yesterday, and we want our research to be timely and appropriate to what's going on. So we reached out to our research team and we asked them to create a piece on reversals so that we could see. Again, this piece is very difficult, and I wish one of the researchers was around today so they could really help us. But Tony and I are going to trudge our way through and see what we can do.
Cute.
In the future, Beth, see if you can set it up so that one of the guys can help us out.
That's a great idea,
maybe
Tom.
One of the guys, you know what? Maybe one of the guys tomorrow can help us out, Beth. We'll try to implement Tom's plan. How about that?
Such a good idea, Tom.
Yesterday, the S&P 500 experienced a very uncommon reversal of over 2%. In the morning, we were down over 90 handles in the S&P. In the afternoon, we were up 60. That is a crazy reversal. We're down almost 2% in the morning and then reversed to up over 1%. That happens very rarely. And we're going to take a look and see how rare is very rarely. Down 90, rallied 140, 150. Actually, I think we rallied over 150 points. So how often do these happen? And do the stats change when implied volatility is higher? These are two questions for you, Mr. Batista. How often do these kind of reversals happen?
In a year time frame? I'm not.
Yeah, sure. In a year time frame.
1.25.
Okay. And are they more likely to happen when implied volatility is higher?
Baby Jesus, please, yes.
Okay. I would have said, just so you know, very close to Tony, I would have said, yes, they're more likely to happen when implied volatility is higher. And I would have said that I think that those kind of reversals like yesterday probably happen around 2% of the time. I don't know. So since 1991, we went back and we looked, we huffed and we puffed, and we ran our servers all night long to come up with 33 years worth of research. Why did we choose 1991? I think that's as far back as our data goes. I don't think we have.
That would make sense.
I don't think prior to 1991, I want to say that all volatility and most of the indexes that we studied were the S&P 100, not the 500. But anyway, that's where our data starts. We observed all the days where the indices were up or down 0.5% or more. Now, remember, back in 1991, 0.5% was like 10 points. Now, or maybe it's 5 points. 0.5% now would be like 27 points. Okay. It's a very different world today, is my point. I don't know the exact numbers. Bigger. We computed the probability of two things happening, Bat. A full reversal where the index is closed at least unchanged, or a whipsaw where the index reverses to close in the opposite direction of where it traded. And we also looked to see if it happened to high implied volatility. Yesterday is what we would call a full whipsaw, because we were down big and we closed up big. A full reversal is down big, closed unchanged, up big, closed unchanged, right? That's the difference.
And the last time that happened was almost 2 years ago. So it's rare.
I mean, according to your informal research, let our research team provide you with the correct information, sir. You are relying on third-party information that may or may not be accurate from Dylan Radigan and his gang of merry thieves.
That's true.
That's Dylan, Ilya, and Chris.
Correct.
So the probability of an intraday reversal to the upside and this is the probability of an intraday reversal to the upside, starts at 20% of the time and goes lower from there. The probabilities increase by 50% when the VIX is over 25. So Tony and I were both correct in saying that when volatility is higher, the probability of a reversal is significantly greater. Okay, that's cool. Now let's look. 1991 to present. We go that the 0.5% is not that big. Yesterday we had, I guess we were down, I guess it would fall in the 1% category yesterday, but it was closer to 2%, but it was still in the 1% category. The probability of a reversal happening for what we saw yesterday was 11%. And when the VIX is over 25, it would have been 18%, but the VIX is obviously much lower than 25. It's about average. So it was about 11% for what we saw yesterday. You could argue it could have been.
I think it was closer to 2%, but
okay, then it would be somewhere between 11% and 5%. We were down almost 2%, but we only closed, we never quite made it. But so anywhere between 11% and 5%, let's say, okay? So that's Tony fair. And I both, it was probably a higher number than Tony and I both thought. The probability of an intraday reversal to the downside was slightly lower than the reversals higher. That's because the market has positive drift. That's because the market goes higher more often than it goes lower. And in this case, the probability of what we saw yesterday, instead of being 11 and 5, would have been 9 and 4 from the upside to the downside. Okay. And if volatility was over 25, obviously higher than that, but it's not. So there's no point in talking about it right now. But the chances of a reversal of a 2%, from up 2% to down 2% and is 4%. We were somewhere between 9 and 4%. But yesterday was an up day, so it's between 11 and 5. All right, you good with that?
I'm good with that, yes.
A VIX of 25 is roughly 50% higher than the average of 18, meaning the probabilities of reversal scale proportionally with volatility. That is a very interesting statement. That means if the VIX goes from 18 to 25 or 26 or 27, it's 50% higher. But if VIX goes from 18 to 36, it's 100%, that higher. So, and if VIX goes higher than that, it could be 200%, all that stuff. So it's pretty interesting that it scales proportionally. The other thing is we're going to take a look at whipsaw reversals, which are defined as being up a certain amount and then reversing and closing in the opposite direction by that amount. Actually,
I'm with you so far.
So actually, the first two slides, I take it back. Those weren't whipsaws. Those were just from being down to being flat or being up to being flat. This is the actual whipsaw numbers. So to see a full whipsaw reversal, the probabilities are all less than 10%. So the first one, everything was less than 20%, just reversing. But to get to a whipsaw reversal, up 1% to down 1% or down 1% to up 1%, the first one right here, this is from down to up. He did it in reverse order this time. So from down to up, which is what we saw yesterday, we were down over 1%. We went to up over 1%. The answer is that happens about 3% of the time. And down 2% to up 2% would be 2% of the time. We were somewhere in between that. So the correct answer for yesterday was about 2.5%. Sorry for the first slides.
That's okay. That's why we should have had a researcher helping us with this.
Should have. But do you see that where it is now? If you flip to the next slide, Beth, this is up to down. And it's about 3%. So it's the same. But from up 2% to down 2%, it's 0.3%. That almost never happens. Mm-hmm. And from up 3% to down 3%, it has never happened. The rarest kind of reversals are whipsaw from being up on the day to being down on the day. This is the rarest. Where the market is up 2% or more, the probability of a full reversal to being down 2% is nearly nil. So there's some really interesting takeaways here. So when you look at this slide right here, this is where we said where the market's up and then it just goes lower and closes unchanged. Yesterday, we were up almost 2%. We closed unchanged, but we weren't quite up 2%. So it's somewhere between 11 and 5, all right? That's what we say here. And then if you go the other way from down 1 or 2% to unchanged, it's a little bit less. It's 9 and 4. And then if you go to this is where we were actually yesterday, down 1% to down over 1% to up over 1% would be a 3% chance, and down almost 2% to up 2%, which we didn't quite make say we'd be 2%. So I'm going to say 2.5% chance. And that's right where we fell yesterday. But the really interesting thing about this whole study is that if you're up big, the chance of going down big is almost nil. So the chance of going
kind of crazy.
The chance of going from down big to up isn't bad. 2%, 2.5%, 3%. but the chance of going from up big to down big is almost nothing. That's kind of crazy. Okay, so for the smallest reversals, the probability start at 20% and go down as the size of the intraday move is larger. So if volatility is over 25, then it's going to move proportionally the same way as it goes up. So volatility is up 50% off its mean, the chances of those moves are going to be 50% greater. The probabilities of seeing a reversal higher are roughly 3 to 5% percentage points higher than the same reversal lower, okay? And meaning that there's a much better chance we're going to reverse from low to high than high to low. And as volatility increases, the probabilities of reversals become proportionally higher.
Good job out of you. Good job out of the research team. We'll take a quick 90-second break and come back. We got somebody who always does a good job. My friend and yours, Mr. Scott Sheridan, next.